The global financial landscape has witnessed a structural shift in income generation strategies, moving away from a historical reliance on sovereign bonds and traditional equity yields towards sophisticated derivative-based exchange-traded funds. This transition, accelerated by the inflationary pressures and equity market volatility of the 2022-2025 period, has elevated covered call ETFs, often termed buy-right strategies, to a central position in the portfolios of institutional and retail investors alike. However, the proliferation of these instruments has introduced a critical challenge: the differentiation between sustainable high-income vehicles and yield traps that suffer from chronic net asset value (NAV) erosion. Navigating this sector requires a rigorous quantitative assessment of how specific funds balance high distribution mandates with the preservation and growth of the underlying capital base.
The architectural mechanics of covered call strategies and NAV preservation. The fundamental tension in a covered call strategy resides in the trade-off between current income generation and the forfeiture of capital appreciation. A covered call involves holding a long position in an underlying asset, typically an index or a basket of stocks, while simultaneously selling, writing, call options against that position. The premium collected from the option sale provides immediate cash flow, but it also imposes a strike price cap on the asset's potential upside. If the underlying asset's price exceeds the strike price at the time of expiration, the fund is obligated to relinquish the gains above that level. NAV erosion, or capital decay, occurs when a fund consistently pays out distributions that exceed its total return, which comprises the sum of capital gains, dividends, and option premiums. This phenomenon is most prevalent in mechanical, index-based strategies that write at-the-money (ATM) calls on 100% of the portfolio. Because these funds capture the full downside of market corrections but only a fraction of the upside during recoveries, their share prices often exhibit a staircase down pattern over long market cycles. In contrast, best-in-class funds prioritize total return through three primary architectural innovations: out-of-the-money, OTM, call profiles, active/tactical overwriting, and daily option reset mechanisms. The calculation of the distribution rate remains a central metric for evaluating these funds, yet it must be contextualized within the framework of the fund's total return. A sustainable fund is where the long-term annualized total return exceeds or equals this distribution rate, ensuring that the income paid to investors is derived from economic profits rather than the liquidation of the investor's own principal.
Comparative overview of strategic income frameworks. Before ranking the specific funds, it is essential to categorize the diverse methodologies employed within the derivative income universe. The market has diverged into two distinct camps: strategic enhanced income and yield maximization. The core features of strategic enhanced income funds generally include option moneyness, out of the money, OTM, portfolio coverage, tactical, 0% to 75%, underlying equities, actively selected or quality, tax efficiency, high, Section 1256 or return of capital, inception volatility, targeted low volatility, long-term goal, capital growth plus income. In contrast, yield maximization vehicles typically feature option moneyness, at the money, ATM, portfolio coverage, fixed, 100%, underlying equities, passive index or synthetic, tax efficiency, variable, often ordinary income, inception volatility, high absolute volatility, long-term goal, maximum current cash flow. Data suggests that while yield maximizers often attract headlines with yields exceeding 15% to 20%, they are structurally predisposed to NAV erosion during volatile periods. The analysis that follows focuses on the top 10 funds that have successfully navigated these trade-offs to protect shareholder capital.
Amplify CWP Enhanced Dividend Income ETF, DIVO. Since its inception in December 2016, DIVO has consistently demonstrated that high income does not have to come at the expense of capital growth. The fund strategy is built upon a concentrated, actively managed portfolio of 20 to 30 high-quality, large-cap U.S. companies that have a proven history of dividend and earnings growth. The alpha of DIVO resides in its tactical covered call strategy. Rather than overwriting the entire portfolio mechanically, the managers selectively write covered calls on individual stocks within the portfolio.
This approach typically involves overwriting only 15 to 25% of the total assets, and only when the managers identify specific stocks that are trading at rich valuations, or when implied volatility provides an attractive premium relative to potential upside. This allows the remaining 75 to 85% of the portfolio to participate fully in market upswings, effectively eliminating the primary cause of NAV erosion found in 100% overwritten funds. Performance data for DIVO as of early 2026. Trailing 12-month yield, 6.2%. 5-year annualized total return, 13.03%. Annualized return since inception, 12.73%. Expense ratio, 0.56%. The fund's underlying holdings, such as Caterpillar Inc. and Goldman Sachs, provide a robust bedrock of industrial and financial stability. This concentration in dividend growers ensures that even in periods of low volatility where option premiums might shrink, the fund still benefits from the natural organic growth of corporate dividends.
JPMorgan Equity Premium Income ETF, JEPI. The JPMorgan Equity Premium Income ETF has become the largest actively managed ETF in the market, with assets under management exceeding $44 billion as of early 2026. JEPI is designed to deliver a significant portion of S&P 500 returns with approximately 35% less volatility, targeting a monthly distribution yield of 7 to 9%. JEPI's structural integrity is maintained through a defensive equity selection process. The fund managers select roughly 100 stocks from the S&P 500 based on low volatility and high-quality characteristics. This defensive core is then overlaid with the sale of out-of-the-money S&P 500 call options. Unlike funds that sell calls on individual stocks, JEPI utilizes equity-linked notes to gain exposure to the index-level covered call strategy. The use of OTM options is critical for capital preservation. By setting strike prices above the current market price, JEPI allows the fund to capture market appreciation up to the strike price before the cap takes effect. During the 2022 market downturn, JEPI significantly outperformed the broader S&P 500 by limiting downside capture, while in the 2023-2025 recovery, its active management allowed it to avoid the severe NAV erosion that plagued traditional buy-right funds. JEPI key characteristics include 5-year annualized return, 9.41%, expense ratio, 0.35. One risk factor specific to JEPI is counterparty risk associated with the ELNs. Because these notes are issued by major investment banks, the fund is technically reliant on those institutions to fulfill the option payoffs. However, the institutional scale and diverse counterparty list mitigate this risk significantly for most professional investors.
JPMorgan Nasdaq Equity Premium Income ETF, JEPQ. As the growth-focused counterpart to JEPI, the JPMorgan Nasdaq Equity Premium Income ETF targets a higher yield and more aggressive capital appreciation by focusing on the Nasdaq 100 index. JEPQ's underlying portfolio closely mirrors the Nasdaq 100, with a significant tilt toward the Magnificent Seven technology stocks. JEPQ employs a similar active management philosophy to JEPQ, utilizing ELNs to sell OTM call options on the Nasdaq 100 index. Because tech stocks typically exhibit higher implied volatility than the broad market, the premiums collected by JEPQ are substantially higher, often resulting in double-digit yields. The evidence for JEPQ's lack of NAV erosion is compelling. Since its inception in May 2022, the fund has benefited from the massive rally in artificial intelligence and semiconductor stocks. Because the managers sell OTM calls rather than ATM calls, JEPQ has been able to capture a substantial portion of this growth. For the period ending early 2026, JEPQ reported a 3-year annualized return of 24.14%, a figure that far exceeds its distribution rate, confirming that the fund is growing its capital base even after paying out its 10.57% yield. JEPQ's ability to participate in the tech rally while providing monthly cash flow makes it a premier vehicle for investors who want Nasdaq exposure without the high volatility and zero dividend yield profile of the traditional QQQ.
NEO's S&P 500 High Income ETF, SPYI. The NEO's S&P 500 High Income ETF has emerged as a competitor to JEPI, distinguished primarily by its enhanced tax efficiency and direct index replication strategy. SPYI holds all the individual stocks in the S&P 500 index, ensuring that its equity core perfectly tracks the benchmark. To generate income, SPYI sells call options on the S&P 500 index, SPX. This data-driven overlay is managed actively to balance income with market participation. One of the most significant advantages of SPYI is its tax treatment under Section 1256 of the Internal Revenue Code. SPX options are classified as Section 1256 contracts, which are taxed at a blended rate of 60% long-term and 40% short-term capital gains, regardless of how long the fund holds them. Furthermore, SPYI utilizes an active tax loss harvesting strategy. By offsetting capital gains with losses, the fund frequently classifies its distributions as return of capital, or ROC. In this context, ROC is non-destructive. The fund's NAV remains stable or grows, but the distribution is not taxed in the current year, instead lowering the investor's cost basis. This structural advantage makes SPYI particularly attractive for high-net-worth investors in taxable accounts. SPYI performance and efficiency metrics. Distribution yield, 11.84%. Annualized return, since 2022 inception, 14.72%. Expense ratio, 0.68%. Since its 2022 launch, SPYI has maintained its NAV effectively, following the S&P 500's general trajectory, while delivering yields that consistently outperform traditional buy-right benchmarks.
Goldman Sachs S&P 500 Core Premium Income ETF, GPIX. Goldman Sachs entered the covered call space with an adaptive overwrite model. GPIX aims to provide a consistent monthly distribution from option premiums and equity dividends, while allowing for significant capital appreciation. The core of GPIX is its dynamic overwrite ratio. Unlike mechanical funds that always overwrite 100% of their holdings, GPIX varies its overwrite range between 25% and 75%. The Goldman Sachs management team uses quantitative models to assess market volatility and directional momentum. When the market is in a strong uptrend or when volatility is exceptionally low, the fund reduces the percentage of calls sold, thereby allowing up to 75% of the portfolio to benefit from uncapped growth. Conversely, in choppy or bearish markets, the fund increases the overwrite to maximize income and provide a buffer against losses. This adaptive model is specifically designed to mitigate the NAV erosion that occurs when a fund is called away during a market rally. Since its inception in late 2023, GPIX has shown high correlation with the S&P 500 Total Return Index, indicating that its capital participation is far higher than that of traditional monthly covered call strategies. GPIX Comparative Performance. GPIX NAV Total Return, 1 year, 15.23%. 12-month trailing distribution rate, 8%. Expense ratio, 0.29%. The low expense ratio of 0.29%, capped through April 2026, makes GPIX one of the most cost-effective institutional vehicles in the category, further protecting the NAV from the drag of high fees.
Goldman Sachs Nasdaq 100 Core Premium Income ETF, GPIQ, mirrors the adaptive strategy of GPIX but applies it to the Nasdaq 100 index. The fund differentiates itself through its flexibility, maintaining a partial overwrite that prevents the NAV from being permanently impaired by sudden vertical moves in technology stocks. The success of the GPIQ model was particularly evident during the market turbulence of 2024 and 2025. While traditional buy-right indices often take years to recover their NAV after a sharp drawdown, GPIQ's adaptive model allowed it to capture the rebound more effectively. Since its inception in October 2023, the fund has generated a total return exceeding 35%, outperforming most of its competitors by a margin. GPIQ Strategic Overview. Distribution yield, 9.81%. Tax treatment, primarily return of capital, ROC. 1-year NAV return, 18.86%. An analysis of GPIQ's distribution composition in late 2025 showed that approximately 96.8% of the payout was classified as ROC, providing tax deferral benefits for investors.
NEO's Nasdaq 100 High Income ETF, QQQI. The NEO's Nasdaq 100 High Income ETF provides a high-yield alternative to JEPQ and GPQ, utilizing the same Section 1256 tax efficiency and tax loss harvesting framework as its sister fund, SPYI. QQQI holds the underlying stocks of the Nasdaq 100 and actively manages an overlay of NDX index options. QQQI's primary draw is its elevated distribution rate, which consistently ranges between 14% and 15%. This higher yield is made possible by the structurally higher implied volatility of the Nasdaq 100, which results in more expensive option premiums. Despite the high yield, QQQI has shown a robust ability to maintain its NAV.
Since its launch in January 2024, the fund has delivered an annualized return of 19.84%. Because the managers prioritize constructive ROC and utilize SPX NDX index options, the fund can pay out substantial cash without the destructive capital liquidation seen in funds like the YieldMax family or older buy-right products. The liquidity of QQQI is another institutional advantage, with an average daily volume exceeding 5 million shares, ensuring that large-scale rebalancing can be executed without significant slippage.
iShares U.S. Large Cap Premium Income Active ETF, BALI. BALI is BlackRock's answer to the demand for defensive large-cap income. BALI utilizes a data-driven process to select a core of approximately 190 large-cap stocks. The strategic goal of BALI is growth at a reasonable price, combined with enhanced income. It differentiates itself by selling monthly OTM call options specifically on the S&P 500 index, while using listed index futures to help maintain full equity exposure. This combination aims to capture more market upside than a traditional covered call fund by effectively offsetting the cap of the written call with long futures positions. Performance data through 2025 demonstrates that BALI is a growth-first income vehicle. While its yield of 6.69% is lower than the NEOS or JPMorgan funds, its capital participation is markedly higher. In 2025, BALI achieved a total return of 14.24%, proving that its NAV is highly resistant to the traditional erosion found in derivative income strategies. BALI Performance Summary: Distribution Rate, 6.69%. Standard Deviation, Volatility, 16.11%. Expense Ratio, 0.35%. The systematic investment approach managed by BlackRock's SAE team provides institutional-grade precision in stock selection, which serves as the primary engine for BALI's capital growth.
FTVest S&P 500 Dividend Aristocrats Target Income ETF, KNG. KNG offers a unique proposition by combining covered call income with the ultimate quality factor, the S&P 500 Dividend Aristocrats. These are companies that have not only paid dividends, but have increased them for at least 25 consecutive years. The fund's strategy involves holding these aristocrats, entities like Caterpillar and Johnson & Johnson, and selling call options to achieve a specific target yield, historically around 8%. Because dividend aristocrats tend to be mature, stable companies with lower than average volatility, the NAV of KNG is naturally more resilient during market corrections. Analysis of KNG's performance over the last 5 years shows a consistent 8.52% annualized return, matching its distribution rate nearly perfectly. This indicates that the fund is successfully paying out its target income using a combination of natural dividends and option premiums without dipping into the principal investment. KNG portfolio characteristics: total assets, AUM, $3.58 billion. Expense ratio, 0.75%. KNG is the ideal choice for conservative income investors who believe that the quality factor is the best defense against long-term NAV erosion.
ProShares S&P 500 High Income ETF, ISPY. ISPY marks a paradigm shift in the covered call universe by being the first ETF to utilize daily options, 0 DTE or 1 DTE, for its income strategy. Traditional monthly strategies suffer from the lock-in effect. If they sell a call at the beginning of the month and the market rallies 5% in the first week, they miss the rest of the month's gains. ISPY resets its upside cap every single day. By selling call options with 1 day to expiration, the fund captures the highest rate of theta, time, decay, while ensuring that any market gains are locked in to the NAV the next morning when a new option is sold. This daily reset allows ISPY to participate in long-term total returns that are consistent with the S&P 500, rather than the lagging returns of traditional monthly covered call strategies. In its first full year of performance, 2024, ISPY delivered a total return of 22.5%, significantly outpacing the 16.8% average of monthly covered call ETFs. Its trailing 12-month distribution rate of 9.8% was fully supported by its 21.49% NAV return during the same period, providing clear evidence that daily resets can effectively eliminate the structural cause of NAV erosion. ISPY demonstrates that time diversification, spreading the option writing across 252 trading days rather than 12 months, is a superior way to generate high income while keeping the capital base resilient.
Quantitative synthesis of NAV stability and total return. The total return of a fund is the most accurate indicator of its sustainability.
If a fund's total return, price appreciation plus distributions, is consistently positive and significant, its dividend is inherently safe. Conversely, if total return is consistently lower than the yield, the NAV is eroding. The following data compares performance and yield on an annualized basis to determine the NAV implications for the top funds. DIVO achieved a 13.48% three-year total return against a 6.20% distribution rate, leading to significant capital growth. JPEQ achieved a 24.14% three-year total return against a 10.57% distribution rate, leading to exponential capital growth. SPYI achieved a 16.84% three-year total return against an 11.84% distribution rate, leading to strong capital growth. KNG achieved an 8.52% five-year total return against an 8.76% distribution rate, maintaining stable capital. GPIQ achieved an 18.86% one-year total return against a 9.81% distribution rate, showing strong market participation. ISPY achieved a 22.5% total return since inception against a 9.80% distribution rate, showing strong market participation. QYLD, historical reference, achieved an 8.79% 10-year total return against an 11.65% yield, resulting in severe NAV erosion and a long-term share price decline from $25 to $17.
One of the primary advantages of covered call strategies in 2026 is their insensitivity to Federal Reserve policy. Unlike fixed income funds, bonds, which lose value as rates rise or offer compression as rates fall, covered call funds derive their income from equity market volatility. If the market enters a period of high uncertainty, option premiums, and thus fund distributions, will rise even if traditional interest rates are falling. The only persistent threat to NAV preservation in these top 10 funds is a sharp market V rebound. If the market drops 20% and then gains 10% in a single week, many monthly covered call funds will hit their strike prices and be unable to participate in the full 10% gain. Funds with daily resets, ISPY, or low overwrite ratios, DIVO GPIX, are explicitly designed to mitigate this risk, making them the superior choices for volatile recovery phases. Conclusion: DIVO and the JPMorgan suite, JEPI, JEPQ, remain the bedrock of the category due to their institutional scale and active oversight. For those prioritizing tax efficiency and taxable accounts, the NEOS and Goldman Sachs, SPYI, GPIQ, adaptive models represent the technical frontier of non-destructive ROC. The critical takeaway is that yield is not a standalone metric. The true measure of an income fund's quality is its NAV recovery ratio, its ability to participate in market rallies while harvesting premiums. By selecting funds that utilize OTM calls, tactical overwriting, and daily resets, investors can construct a portfolio that delivers a sustainable 8 to 12% yield without the slow death of capital erosion.